Dano Capital and Alicia Levine of BNY Mellon Wealth Management. Alicia, I wanted to start with this quote from Bank of America, which I think captures the conversation perfectly. They say the following: the market seems to be sitting at the threshold of a major bifurcation of scenarios with material implications for likely rate ranges, both near term and over the current cycle as well. Does that resonate with you right here, Alicia? Are things that finely balanced?
So I don't think it is that finely balanced, although the risks have definitely increased. And that panoply of commentators that you just showed really are expressing that. And what have we known for the last couple of months? We've known that we are in a period of peak everything and that you can only reopen once. And that means all that terrific data that we saw in May, June, and part of July, by definition, is going to come off the boil and is going to start to normalize. But I'd say this, with $2.4 trillion still remaining in excess savings and liquidity in the markets, we think actually the outlook is strong, although there are risks that remain. In particular, if you think about it, the U.S. recovered all of GDP in a V-shaped recovery while missing 9 million workers. What does that mean? That means productivity went up. And that means very good things for U.S. growth going forward. And this U.S.-China divorce means that ultimately we'll have better manufacturing here in the U.S. So we're more positive than negative, but clearly the risks have gone up.
Alicia, you make some really good points. Pete, I want your response to that quote from Bank of America as well. They can envision scenarios where we have a 10-year yield that finishes the year north of 2% or south of 1%. This is the issue with the market right now. For a lot of people, at least, there is a consensus, but it's a low conviction. Low conviction into year-end, low conviction into next year.
Yeah, the bifurcation in rates does to some extent make sense, because you have a scenario where the 10-year finishes above 2% due to the Fed's reaction function to inflation, and that would be our base case. On the other hand, you have an equally unfavorable scenario where the Fed continues to buy bonds and does not taper because of the Delta variant. And I think to some extent the B of A commentary resonates with me, because the risks have shifted since the beginning of the year. Earlier in the year, the Delta variant did not exist. Vaccinations were picking up. The reopening was accelerating, not decelerating. Inflation was a potential rather than in existence, which it clearly is at this point. Trying to just wish it away, I don't think works anymore. And so as the risks have heightened, clearly, we're a lot closer to the scenario that they've articulated.
Alicia, speak to that. Retail sales downside surprise. Consumer confidence, the lowest we've seen since 2011. What's the driving force behind that?
So I think what you're seeing is the shift over to a more normalized economy and less of that euphoria. I'm not going to let a couple of data points necessarily change the outlook here, because I think we're still going to be at relatively high levels of consumer spending going forward. If you think about the retail sales report, that is actually heavily skewed towards the goods sector. And as we know, there was a renaissance in goods buying in the last 12 to 15 months. And so not all the services are reflected there. So I think it's a little bit of skewing of what the actual picture is. But it is true that the risks have increased here. I just think that there's still, I think ultimately, if you do get boosters going, there's a way out of this, right? So what does the market look at?
Yeah.
It's not going to follow the day-to-day numbers. It's going to ask the question, is there a way out of this? And I think there is a way out of this. And ultimately, that's what you see the administration signaling today by encouraging boosters. If that's the case, the market will look through it. Ultimately, though, it is true that stimulus is rolling off, and it is true that the real economy is going to have to take over from monetary stimulus, and that has to happen in order to move the market much higher. We do think that happens, though.
These are all issues